So we tend to stick with a single number. And the way we develop that single number is everything you've described. We look at what could the PE be, what could the earnings power be, where could the surprise come from, how much will liquidity matter, and how much would risk appetite matter. And sometimes risk appetite is the most important thing, sometimes earnings. And then we actually have to use judgment to decide which one's the most important and come up with a single number. So I would say our targets aren't science, but it's where we're the most confident that that's the most probable path. And it's a process we've been doing since 2009, actually since 2008, and it's actually worked pretty well. I know when I was at JP Morgan, for the first 6 years, we had identified the closing price for the S&P 5 of the 6 years within 1%.
Tom Lee continues to be one of the most upbeat voices on Wall Street as investors question whether the recent run can continue. Lee sees strength developing beneath the surface in stocks, cryptocurrency, and the overall economy, while others are cautioning about corrections and volatility. He thinks a strong parabolic increase across risk assets in the second half of 2025 might surprise everyone. Lee notes that markets have continuously resisted pessimism in spite of the uncertainty surrounding inflation, interest rates, and global growth. Fear-driven headlines, forced sales, and leverage unwinds may frighten investors in the short term, but the long run reveals a totally different picture. Much like past turning points Bitcoin in 2017 or stocks in 2009, Lee argues that we're on the verge of a major breakout. He believes that both Bitcoin and equities could reach new all-time highs as investors realize that the worst fears of recession and inflation have already been priced in. For further updates on Bitcoin and the wider world of digital assets, please take a moment to like this video, subscribe to the channel, and enable post notifications before we go any further. Thanks, and enjoy the video.
I'd say if I was to give you a more summary form, there's a lot of things we consider. One of the first things that we keep in the back of our minds is that the equity market is the junior piece of the capital structure, which means that stocks respond to economic data and to bonds and to risk, and therefore all of that ends up affecting how the stock market does. So we don't look at the stock market as the tail wagging the dog, it is the tail of the capital structure. And a second principle we always keep in the back of our minds is that consensus tends to be risk-averse and crowded. So meaning what is a widely held view and might even be the most logical is probably also the most logical for most people, and therefore it's not actionable. So we try to think about where the variance or the surprise would occur relative to consensus. And often it makes you come to a counterintuitive conclusion. The third thing that we always keep in the back of our minds is that there are longer-term drivers of markets, and I think the most underappreciated is demographics. That demographics are more important than even economic policy. And it's something I learned when I was a wireless analyst. You know, before I became a strategist in 2007, I'd spent the prior 14 years of my career as a technology analyst covering the wireless industry. And one of the things I learned was that the potential of the wireless industry was underestimated by most people because they didn't think about the demographic impact. That if 18-year-olds had a adoption rate of 100%, like you could see it in Korea in the early days, that meant that as they became 40 and 50-year-olds, the penetration rate of older adults would get to 100%. That means wireless would grow vastly over time because of this demographic impact. We found that the stock market really follows very closely the demographic cycles of people aged 30 to 50. And that's kept us bullish since 2009 because that's when that demographic actually bottomed. And the fourth principle we have is that you can't fight the Fed. So in 90% of the instances, when the Fed is dovish, you have to be bullish. And when the Fed is hawkish, you have to be bearish. But 2022 and 2023 was really the exception because in late 2022, the Fed had to be hawkish optically, but actually they turned dovish. That's the reason we had turned bullish and stayed bullish in 2023 because even though the Fed was explicitly hawkish, they were actually dovish. But I would say those four principles govern almost 80% of how we view markets. So we tend to stick with a single number. And the way we develop that single number is everything you've described. We look at what could the PE be, What could the earnings power be? Where could the surprise come from? How much will liquidity matter? And how much would risk appetite matter? And sometimes risk appetite is the most important thing, sometimes earnings. And then we actually have to use judgment to decide which one's the most important and come up with a single number. So I would say our targets aren't science, but it's where we're the most confident that that's the most probable path. And it's a process we've been doing since 2009, actually since 2008, and it's actually worked pretty well. I know when I was at JP Morgan, for the first 6 years, we had identified the closing price for the S&P 5 of the 6 years within 1%.
Ethereum is not merely remaining stable, it is beginning to gain ground. Ethereum has surpassed the majority of the main cryptocurrencies as 2025 draws to a close, thanks to record on-chain activity, growing developer participation, and growing institutional interest. Although Bitcoin is still the market's cornerstone, Ethereum's momentum indicates that it may be the engine of this next stage, paving the way for what analysts predict will be its most powerful rally to date. We're on the verge of enormous expansion, according to Tom Lee, who is renowned for his long-term optimism regarding digital assets. Lee is certain that a long-awaited boom is imminent as huge institutions like BlackRock are venturing into the cryptocurrency space. By the end of 2025, he estimates there may be more than 1 billion active cryptocurrency wallets globally, making it the fastest time in history for wealth generation. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content before we go any further. Now, let's get into his powerful predictions.
The few things I learned in wireless was, I think, pivotal to how I view markets. I mean, foremost, the wireless industry didn't generate money. The industry was always borrowing money. And so we had to develop a way to actually value the stocks, the equities, without earnings. And for most of my first, let's say, decade of that career, most people I met would say, Tom, the wireless industry is worth zero because they don't make money. But we'd always be like, well, what is the value of their subscribers or the spectrum they own, because they aren't capitalized on the balance sheet, and eventually they make money, but they have to spend marketing dollars to acquire the customers and build the networks. So it was really during that period that I learned a couple of things. One was that you can follow what the bond market is doing to know if there'll be moves in the stocks. So I learned to call our high yield desk every day and ask them the levels of different companies and were they trading better. And of course, if a bond started to trade well, then that meant that the bond market sensed something was improving, and therefore the stock would react. And so that was very helpful, and it really taught me to look at stocks as the junior piece of the capital structure. Whatever bonds are doing, stocks will follow. Another thing I learned was how important the intangible value of an equity is, because in the wireless industry, they had to front load the cost of building the network and then acquiring a customer. So they didn't make money until 1 or 2 years later. And the wireless industry operated as what you'd call a long-term greedy business. They weren't trying to make money in the short term, but all the investment they were making created value in the future. I mean, that's today pretty widely accepted as the lifetime revenue of a customer, or we call it long-term greedy. And that's, a life lesson that you really shouldn't try to maximize how much money you make now. It's more important how much money you make over the cycle. And that's how we look at the equity markets. I think the third thing that really puzzled people was that when I was a wireless analyst, and I became pretty well known as a wireless analyst. In fact, I became institutional investor ranked only 2 years after starting coverage of the stocks, which made me, I know at Smith Barney, I was one of the youngest managing directors. I was 28 when I became a managing director there. And I was very, very fortunate to pick stocks almost at the bottom. And people always asked me, and so I had some very famous bottom calls. One was Western Wireless, which I upgraded at $1.76 the day of the low, and it was acquired by Alltel 18 months later for $40.
Wow.
And I upgraded Alamosa Holdings, which is a Sprint PCS affiliate, at 37 cents, and it got bought by Sprint for $22. So these were hundreds of times returns on investment for stock upgrades. And people ask me, how am I picking bottoms in stocks? And what I have shared with my friends but never shared with my clients was that the stocks I would upgrade was based on me talking to all of my clients. And, at the time I might have 70 or 80 clients, so it wasn't hard to talk to everybody. And the ones that they were the most bearish on were the ones that I would upgrade. Okay. And the ones they were the most bullish on were the ones that I didn't think would work. And it's an example of how consensus gets crowded. So I use those same principles today when looking at markets.
According to Tom Lee, his early years spent studying the wireless sector fundamentally altered his current perspective on markets. Those businesses were losing money back then, and they were often taking out loans to expand their networks and draw in clients. Because they didn't earn money, many people wrote them off as useless. But Lee discovered that there was more to them. He saw that these businesses had intangible worth in their client base, technology, and future prospects, albeit despite the absence of earnings. Additionally, he discovered that the bond market frequently provides early warnings about stock market developments. When a company's bonds begin to trade more favorably, it usually indicates that investors think its financial situation is getting better, and the stock price usually follows suit. He learned from this that equities are the junior piece of the capital structure, meaning that developments in the stock market sometimes lag behind those in the bond market. Understanding the significance of long-term value was another important lesson. Because they had to make significant upfront investments, wireless companies did not immediately turn a profit. Later on, though, those investments paid off. Lee refers to this way of thinking as long-term greedy, which holds that success arises from concentrating on your earnings over the course of a cycle rather than your earnings now. Finally, he shared how he developed his reputation for calling market bottoms. Instead of following the crowd, he did the opposite. When most of his clients were the most pessimistic on a stock, that's when he would upgrade it. He noticed that when sentiment becomes too one-sided when everyone's bearish, it's often a sign that the market is near a turning point. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.